Wallbridge Mining has released an updated preliminary economic assessment for their flagship Fenelon Gold project. The prior update, issued in June 2023, was based on a gold price of $1,750 gold. This latest update bumps that figure up to $2,200 gold, with part of the reason for the revised study being the rising price of gold. Funnily enough, that revised study was conducted at a price nearly $1,000 below the current spot price of the metal. But a higher price of gold hasn't exactly saved the economics of the project here. Let's dive in. Wallbridge last week published a preliminary economic assessment that by most measures was worse off than a prior estimate released on the project. But the studies aren't entirely directly comparable. The focus of this new edition, aside from updating the implied price of gold, was intended to establish a lower risk, higher grade, lower startup capital scenario. Of course, it also updated the estimated costing from contractors and suppliers, given how inflationary recent years have been. From a high-level perspective, this new PEA outlines a mine that would operate for a longer time period while producing less gold overall at higher costs than initially anticipated. On the flip side, average grades are estimated to be higher, while initial upfront capital expenditures as well as sustaining capital requirements are lower, and the payback period is shorter too. In other words, there's a bit of give and take here, but Wallbridge thinks this is the right step forward when compared to the prior plan. Investors, however, appear to think otherwise given the sell-off we've seen in the days since the announcement. Anyways, okay, so let's start with the new PEA. Under the revised framework, Wallbridge has outlined a project boasting a net present value of $706 million on an after-tax basis, which is based on $2,200 an ounce gold and a discount rate of 5%. The IRR is said to be 21%, while the payback period from the start of commercial production is said to be 4 years. At $3,000 an ounce gold, the economics are said to improve to an NPV of $1.4 billion, which the IRR bumps up to 34% and the payback period falls to 2.4 years. The estimate is based on a scenario where Wallbridge would operate the Fenelon mine over a 16-year mine life, with average annual production of 107,000 ounces per year. Much of that production is weighted to the first few years of production, however, with the first 5 years expected to average 127,000 ounces a year. Over the life of the mine, a total of 1.7 million ounces are expected to be pulled out of the ground. These assumptions are based on a gold recovery rate of 96% from a mix of both underground and open pit mining, with the average gold grade being 3.34 grams per ton. The operation is expected to process about 3,000 tons per day. Under this scenario, initial capital expenditures are estimated at $579 million, while sustaining capital expenditures are estimated at $449 million. On a per ounce basis, cash costs are estimated to come in at $851 an ounce, while all-in sustaining costs cross the $1,000 mark at $1,046 an ounce, which, given the fact that gold is presently around 3 times that, leaves plenty of room for margin. Based on that $2,200 an ounce gold price, average annual free cash flow is expected to average about $120 million over the entire mine life. Okay, now let's take a look at the prior version of the PEA, and then we'll do a cross-compare. The prior PEA, completed under a somewhat different management team, estimated an after-tax net present value of $721 million at $1,750 gold, alongside an IRR of 18%. At $1,950 gold, the NPV was said to rise to $1.1 billion with an IRR of 24%. The payback period, meanwhile, was said to decline from 5.4 to 4.2 years. So you can already see why some investors may be upset. The scale of the operation under the prior version was also quite different. The Fenelon mine was expected to produce on average 212,000 ounces of gold a year over a 12-year mine life, with life of mine production expected to come in at 2.61 million ounces. To do so, the operation was expected to see recoveries of 96% of gold, while processing 7,000 tons per day at an average grade of 2.73 grams per ton. Initial capital under this scenario was estimated at $645 million, while sustaining capital was estimated at $594 million. Cash costs, meanwhile, were to come in at $749 per ounce, with all-in sustaining costs of just $924 per ounce of gold produced. Average annual free cash flow was estimated at $157 million over the life of the mine. So, looking at the data here, investors have a bit of a right to be, well, pissed. What was to be a 212,000 ounce per year project, which many majors would likely be interested in, has been cut in half to a 107,000 ounce per year project. And there isn't seemingly a whole lot of benefit from doing so. Expected free cash flow may not have halved, going from 157 to 120 million per year, but it's not like the capex figures have changed all that dramatically. Initial expenditures have fallen by just $66 million, while sustaining expenditures have fallen by 145 million. Granted, the cost of everything has gone up since 2023, but that doesn't exactly justify the expenditure difference in going from a 7,000 ton per day operation to a 3,000 ton per day operation. And despite more than halving the processing capacity, cash costs and all-in sustaining costs have still moved higher. Yes, there's fewer ounces for those costs to be spread across, but at an operation half the size. Well, presumably, there should be less costs that need to be spread. And yes, grades have improved, but that leads to 900,000 ounces being left in the ground that otherwise would have been recovered. And at $3,100 an ounce gold, that seems like it's getting kind of hard to justify, especially when we were told that those ounces were economic to be recovered $1,350 an ounce ago. Finally, the payback period. Despite the rising gold price, it still seems to suck, which brings into question the likelihood of this thing ever getting off the ground at all. All right, so let's wrap it up. This was a rather high-level comparison, and we're aware of that. But here's one of the realities that bites a bit. We're now 2 years out from the initial preliminary economic assessment conducted on Fenelon. And what do we have to show for it? Another PEA, which is still based on indicated and inferred resources, which, by the way, saw indicated resources actually decline versus the estimate from 2 years ago. This means that the project has spun its wheels for the last 2 years, which isn't exactly a positive sign for investors. Significant exploration is still required to move those resources into higher confidence levels, but with a share price of 5 cents, that gets awfully tough to fund. The bright side here is that they still have $21 million on the books as of last year. Let's see what they can do with it. All right, everybody, thanks for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Also, if there's stories you want us to cover, let us know in the comment section. Thanks for watching, everyone.